I've seen mom and pops that are so crazy in order to improve their numbers, they're literally making cash deposits into bank accounts and saying those were rent payments on vacant units. So in order to boost their NOI, in order to boost their occupancy, they were making separate deposits into a bank account to prove they had made that were collecting rent, even though those units were vacant.
What I have seen is a seller guaranteeing 90 or 95% occupancy, or maybe even 100% occupancy. So basically, he was going to say, I will put money in the account for these rents because it boosts the NOI so much that, I mean, the offset and the price will offset him putting money into the account.
I mean, I was involved with a deal where they were using all the repairs and maintenance magically became CapEx. So it's like, how can you have a Class C 1970s build property with only about $200 a unit a year in repairs and maintenance? That's impossible. They dumped it all into CapEx to make their NOI look higher.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting.
Hey everybody, welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my co-host, Frank Patalano, here with me. How are you doing, Frank?
Another great day, sir.
Another great day of trying to make money and failing miserably.
Doing okay.
Not failing miserably, but not doing as well as I would like.
Yeah.
So I walked a property the other day, met some brokers out there. Now, I walked this property probably about 2 other times. It's been on the market, comes up every couple of years or so. I don't think it is sold, but it got me thinking that sometimes deals just die during the whole due diligence period. So when I go walk a property, yeah, that's like me starting due diligence, but it's actually not the due diligence period. That's just me doing recon on it. Does that make sense?
Definitely.
So what I got thinking was, like, I walked this property and right off the bat, I can start seeing a bunch of issues with, like, the balconies, the steps, the circuit breakers. I mean, yeah, the units inside look fine, but there's a lot of exterior issues. And so it's like, I'm not an inspector, I'm not a contractor, I'm not into construction, I'm not an electrician. So if I'm seeing things are probably going to be bad. Wait until due diligence, wait until I'm under contract, and then I have like an electrician and a plumber and the construction guy go out and inspect. Then what does that really show, you know? So got me thinking. It's like, yeah, if I am inexperienced and I'm just an operator, I'm buying a property and I don't know what it looks like. Yeah, I get under contract for this property for, say, 15 million, and we start doing our due diligence. I put up $150,000 of earnest money, and now due diligence period is coming up, and I find like a bunch of issues with it. It's like, can this kill the deal? And do I want to lose $150,000 and try to, like, fix the deal down the line, or potentially like lose everything? So I mean, deals can die in due diligence, basically, and so you really need to take your data from due diligence and do what you need to do and make meaningful decisions, and don't try to just save your risk capital for a potential problem down the line.
So with what you're saying, I mean, if you write a good LOI and you have the right words in there and you negotiate a good one, I'm not worried about the earnest money as much as worrying about all the sunk costs of the due diligence. So, we did a deal where we ended up walking, and the attorneys got like $12,500,
Yeah.
and we didn't even close the deal.
Well, so yeah, you have your attorney fees, you have your lending fees, your origination fees, so that they can get all their third parties going. You have your inspector fees.
Appraisal, yep, the
All,
inspections.
all of that adds up. So, I mean, yeah, I was saying earnest money, but really what I meant was just the risk capital, because all
Yeah,
of that is a risk capital, and it can add up.
yeah. You
And
you definitely have to be willing to walk away from a deal that you've spent risk capital on if the deal's a bad deal.
yeah, and you just said you had to walk away from a deal, right? You lost some of that.
Oh, we've had a number of deals. Too many deals um, where you've put money in, and then in the end you find that the deal was not going to work. It wasn't good enough. It wouldn't cash flow the way you predicted, based on after doing all the due diligence, and you have costs that you can't get back. Besides your time, we're
Yeah.
just talking about actual dollars. I mean, roof inspections, tons of things.
So why don't you talk about one of your deals where you did all of that and why it fell apart?
So I'll talk about a hotel in a foreign country. We were looking at a 22 room hotel there was definitely potential, but the numbers in the end, when you see the actuals versus what the pro forma is, when you saw the property itself and how each unit was a completely different style, when you saw that it was just a little too far on the wrong side of the street from the beach, that really can affect the prices. And when you decide how much money you had to lend or borrow to buy it, especially if you had investors involved, it's like, guys, we're not going to make anything on this. But I mean, it's a process. So we had already paid not a lot, but we had paid a few people, including the syndication attorney, to get started on the syndication.
I guess what so to break it up, when you're underwriting, you're using the assumptions, you're taking the seller's information, and you're going to move forward with it. But then during due diligence, you actually gather real data, real inspections, real third party reports, and you shift from projecting to projecting reality, saying, "Oh, we can make a ton of money on it," to confronting reality where you're not going to make any money at all.
Yeah, I mean, other examples for this property, it's like, what do you mean there's another employee that you didn't have, that you had off the books? You know, what do you mean that breakfast is costing you that much money? What do you mean that you're not paying insurance on this property? You know,
Yeah,
a
yeah.
lot of in some foreign countries they don't pay any insurance. I'm not even talking liability. They don't have building insurance or liability insurance. It's like, guys, I have too much to protect. I'm gonna have insurance no matter what. And that insurance might cost you $12,000, $15,000 a year, and that they're not paying any insurance on it. They're self-insuring. You know,
So and every foreign country's different. But if
absolutely.
someone gets injured or dies on your property, do they have legal recourse to come after you? Or because I don't think countries are as litigious as the US
There's
is.
definitely places that are not as litigious as the U.S., but I
Yeah.
mean, there's still the chance. And this the electricity is much higher than you expect. Or if you want to add solar, I mean, solar alone could, they don't finance it like in the United States.
Mm,
If you're shipping in the product yourself, you might have to pay quite the tax, the import tax, etc. All these little things start to add up over time.
yeah.
You know,
So I always tell my students and clients, it's like you can have the best underwriting model in the world. It can calculate everything for you, spit out everything you need. But if you put garbage in it, you're going to get garbage out. It's the whole GIGO principle, GIGO. And so, really, what this due diligence comes down to is minimizing the amount of garbage going into your model so that you can have the best underwriting you can for it. Um, so you mentioned no insurance, and you're going to have insurance. So basically, T12 is being like underestimated on expenses or whatever, or understated, basically. And so you can't really use that to move forward because you basically have to come up with your own expenses and your own income and everything like that.
Well, I mean, on
Right.
the opposite side, you could say their argument could be, well, we're also collecting income that's off the books as cash. It's like, yeah, that's not as easy to predict either. It's like everything has to be above board. It's like, what are you guys actually setting using for your taxes? So the little things like that as well.
Yeah. So and I know we were going to do a foreign country investing at a later episode, but if you're in the United States, you really can't get away with some of those things that people can get away with in other countries.
Um, you and I have both looked at many deals. And when people have pro forma, there's definitely a lot of play and a lot of gray on what they forget to include. But overall, I agree with you. But I mean, like right now, we're looking at a possible bar in on the West Coast. It's a bar in combination that I might be investing in, and it's like there's a lot of cash transactions.
Yeah. So I'm trying to stick to like multifamily, commercial multifamily. So there's going to be hopefully zero cash transactions. And that's one thing that all of our managers do is they do not take cash for rents at all. They try to get away from checks and money orders. They prefer everyone signing up through their portal. One, it keeps them from. I mean, we had our one of our properties steal the Dropbox and walked away with a bunch of money orders. So you're when you do all that, you're trying to minimize that risk of someone stealing them. But it also keeps everything on the up and up, and it's supposed to be more convenient for their residents if they can just pay for it over a computer versus having to go down to the 7-Eleven and get a money order and bring it back. So
I've seen I've seen mom and pops that are so crazy in order to improve their numbers, they're literally making cash deposits into bank accounts and saying those were rent payments on vacant units. So in order to boost their NOI, in order to boost their occupancy, they were making separate deposits into a bank account to prove they were collecting rent, even though those units were vacant.
I
I'm
haven't
not trying to
seen
scare people, but
I haven't seen that. What I have seen is a seller guaranteeing 90 or 95% occupancy, or maybe even 100% occupancy. So basically, he was going to say, I will put money in the account for these rents because it boosts the NOI so much that, I mean, the offset and the price will offset him putting money into the account.
I mean, I was involved with a deal where they were using all the repairs and maintenance magically became CapEx. So it's like, how can you have a Class C 1970s build property with only about $200 a unit a year in repairs and maintenance? That's impossible. They dumped it all into CapEx to make their NOI look higher.
Yeah.
So these are the kind of things you look at in due diligence.
Yeah. And there are rules of thumb, heuristics. Now, granted, they are you take them with a grain of salt, but you still need to at least think about it whenever you're looking. It's like you said, 1970s Class C, a couple $100 a month or a couple $100 a unit for repairs and maintenance. It's like, well, does that make sense? It's like, no. What would make sense? 500-600 bucks, maybe 700-800, depending on the quality of the unit. I mean, this is why you have to walk the units. You have to walk every single unit when you do your due diligence. Typically, the ones you can't walk are going to be more problematic than the ones you can. So, ideally, you want to walk 100%.
Yeah, you figure those 3 units that you can't walk, you might as well figure them as gut jobs.
So what does that do for your NOI? If you're going in, assuming 300 in expenses for repairs and maintenance on 100 units, what is that? You have your calculator handy?
I do. You want me to multiply what? 300 times 100?
Yeah, 30,000 on a 6 cap. Let's do let's do a 6 cap or 7
That's
cap.
$500,000.
So $500,000 in valuation lost right there. So this is where you either going to start retrading or walk away or figure out some other way to get around it. And then I was also going to say that property that I walked the other day. So they have balconies. They have like a second floor, and there's like a wooden walkway, kind of like our other property we have. And last time we were there was rotting wood underneath it. But what they ended up putting up was like 1x6s, little thin, looks like fence panels or whatever. Slapped it over it, made it look pretty. But if you looked up underneath it, that wood was still rotted. They just kind of put a band-aid
Oof.
over it. So that is asking for problems right there. That's asking for a lawsuit if someone steps through it and breaks a leg or something. So
Yeah, that's crazy. But
so
I mean, before due diligence, when you're in the underwriting stage, you're using everything the seller provided. You're using the offering memorandum. You're looking at pro forma numbers. If they're not flat out lying, you're looking at a perfect case or a best case scenario on how the property should perform, right?
yeah, you're looking for red flags too. You're looking for things that just don't make sense.
No, I'm not saying what
And
you're looking for. I'm just saying what you're looking at. You're looking at their numbers
yeah,
and
they're putting lipstick on the pig. So they're going to make that pig look as pretty as possible. They're going to make those numbers look as pretty as possible. The broker is going to send you loan quotes from like agency, Fannie Mae, Freddie Mac, whatever. And everything is going to be like 100% perfect. You get this, you can just do all this, and then 45, 60 days later you have a property. And that's not the case. I get agency quotes like from brokers for properties where I know agency is not going to loan to. Like in
yes.
our market, agency is not going to loan here, but they will still give you a little soft quote or whatever to start running your numbers with. That absolutely mean nothing. So
I was gonna say how generous of them.
yeah. So you get perfect scenario from the seller and the broker. Their job is to sell the property. They don't care if anything happens to it after that property is sold because it's not their problem anymore.
Versus when you get to due diligence, at least during the due diligence time, you're spending money for it, but you're getting some real stuff.
Yeah. You are spending money.
Not for all of it, but for some of it.
So your due diligence is actually an investment in the property, an investment in the project. It's like, all right, I'm going to invest $25,000 into this. Will it make me more or will it save me more if I walk away? So if you go in, you put in $25,000 in inspections and all these stupid fees, lawyer fees, everything else, and you end up walking away and you say, oh man, I lost 25,000. That's one way to look at it. Or you could look at it and say, well, I just saved my investors $7.5 million
And 4 years of my life.
and 4 years of my life. So I mean, when you think about it that way, I mean, yeah, it's people tend to hold on to what they already have versus think about what they would get in the future. And so that's sort of the mentality. It was like, well, I don't really want to lose the 25,000, and our earnest or our due diligence period is up on Tuesday, so we have to make a decision. And if on Wednesday we make the decision, we're out all our earnest money and stuff like that. I mean, people are going to want to hold on to that money as long as possible. And I understand when it comes to 6-figure earnest money and high 5-figure um, risk capital for all your fees and inspection costs and everything, people don't want to lose that because I completely understand that.
We have a
But
deal right now. We're in over $1 million. That's still in due diligence. That's still in. It hasn't closed yet. You know, it's just between the roof inspections and everything else, the weekly meetings with attorneys from both sides to make sure this thing keeps moving forward. Oof.
Yeah. I've had, or my mentor has had to walk away from seven figure losses, risk capital losses. So, but I mean, seven figure losses up front save you nine figure losses down the line. So,
So, looking at the T12, there's obviously, I joke that when I go to the local grocery store, I always try to find one mistake on the receipt. So the same thing when I look at a T12, I'm always trying to find at least one mistake on there. What am I missing? You know what I mean? What is miscategorized sometimes?
yeah. Like one big thing that, like you said, is CapEx versus repairs and maintenance. That is typically a big one. That is playing in the gray area. Sometimes it's just you're playing in the straight up black and white area, and that you need to stop doing that. Gray area is the gray area for a reason, but you replace a dishwasher. Is that CapEx? Is that repairs and maintenance? Or you repair a dishwasher? I mean, it's like, yeah, I can replace a dishwasher for what, $300, or I can repair it for $350. So I mean, lot of gray area there. Broken window. Oh, new window. That's CapEx. It's like, no, that's not CapEx. But new paint job. Oh, paint job. We're painting a bunch of units. That's going to be CapEx. So I mean,
I'm laughing at the T12 where every number is rounded.
that I I personally like the T12s that come from like a reputable property management, or at least software like Resman, or was it Real Page One Site or whatever, one of
Yep.
those that actually takes the actual numbers from the last 12 months versus I've had T12s written out on basically a legal pad. It's
Yep.
like, well, what about taxes? Oh yeah, taxes. Oh, that's about 18,000. No, what about this? And then they'll just keep adding it, and it's like, okay, so where are you making money now? It's like, oh, we make about $300 a month. It's like total. It's like, yeah.
Yeah, one of the big problems that I've seen lately on some deals is how much the CapEx is going to be.
Yeah.
You always think it's going to be a certain number, and it usually ends up being twice that.
Especially with plumbing. You and I
Yeah.
both have seen plumbing. We estimate 40K for plumbing issues, and we end up spending 80K, and we end up having to house residents in a hotel for 2 weeks, and that gets expensive really fast.
Well, I mean, we had one deal where we refied it, and it was agency, and what happened was is there's the what do they call it? Some kind of the conditions report, property conditions report, and there was definitely a misunderstanding of the wording of what needed to be done with the parking area. My partner, who was way too positive about life, thought that we could do like a road base, and that would cost us $40,000, and we'd be all done. But in the end, the agency, Fannie Mae, I can't remember if it was Fannie Mae or Freddie Mac, but they wanted about a $200,000 road parking lot upgrade. But they'd only escrowed 40,000 for it. So it's like, whoa.
Yeah. So if you underwrite your CapEx and you're estimating maybe what 300K for something, but now it's going to be actually 750 or so,
Yep.
your delta is what, 450K.
Yep.
What is that valuation on a
That's
six
quite a
cap?
difference.
$7.5 million.
Yeah, that's massive
Yeah.
for $300,000 or
Yep.
$450,000. The
Yeah, for
delta.
450K delta is a huge impact on your valuation. So if your CapEx doubles, your deal is not the same deal as you originally were thinking it was. This is when you need to either revisit, retrade, or walk away.
Not
Um,
to scare people, but we had one where the insurance went up, but it didn't go up crazy, so we were still in the deal. But then the next year, the insurance we took a massive hit where the insurance almost the original insurance quote. So the carrier that we were using decided to leave the state. So the first quote we got from a new carrier was three times. the
Yeah.
insurance. We ended up getting something just around double.
So insurance and taxes are like wild cards because those can change way off of your projections after you close the deal, and you have like almost zero input into that. You can't help that an insurance company leaves the state. You can't help
Can't predict
that.
it.
You can't help that the 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 city that you're living in decides to fraudulently approve schools being built when the referendum voted against it and the city passes it anyway and increases your taxes accordingly. You can't I mean sometimes they just increase taxes all on a whim too. So I mean you can't help that. But you can help these other things. Your CapEx, your deferred maintenance, going through your T12, making sure everything looks good.
I mean, I'm sure
Hell,
we've mentioned it before, but I'm just thinking of the concept of physical occupancy versus economic occupancy and
yeah.
how wildly different that can affect how much money you're making.
Yeah, I was about to get into lease audits. That's a big thing for due diligence. It's not fun, but it's where you go through every single lease, figure out what each person is paying, and then when you're walking the units, it's like your lease, you check the lease. All right, this person is just paying for a single whatever, one person on the lease. And you go in there and you got like four adults living there and three pets, and nobody is paying pet rent, paying their pet fees or anything like that. And then you got 20 of those in a 100 unit complex. All of that adds up. So, and then also all of the deferred maintenance of having that many pets in a single unit can be detrimental to that unit. So we talked about, and we talked about insurance in depth. We have a series that we talked about in the last few episodes. So if you're interested in insurance, I would recommend going back to the first one with our guest JT Lynch, and then we carried on from there. Um, Physical occupancy versus economic occupancy. So this is kind of weird where you were having those people depositing money into an account to boost up their economic occupancy while their physical occupancy remained low. Typically your economic occupancy is lower, but
No, they faked that units were being rented.
yeah.
Yeah. So the physical occupancy was looking higher too, but their actual physical occupancy wasn't there.
Yeah. And this goes back to my mentor on his first property. He was guaranteed that when he bought it, it'd be like 100% occupied. And so the seller ended up just pulling people off the street and putting them into the units. They weren't paying rent or anything, but hey, they were still occupying it. So the physical occupancy was 100%. Economic occupancy, I think, was like in the 60s or 70s.
Crazy.
Delinquency issues, resident base quality. It's like this is why you have to do your lease audit. You go through, you see what their salary is, and does it meet a minimum requirement of typically three and a half times your monthly rent, or if you're in a Class C neighborhood, Class C property, you might drop it down to 2.5%, but ideally you still want it to be around 3. So
Yeah, the main thing I would say is that when you're walking the property, don't just walk it during the normal business hours. Don't just walk it between, at 12 o'clock or 2 o'clock or 4 o'clock. Walk it like 7 o'clock at night. It might have a different vibe.
it would have 100% have a different vibe. And if you can, walk it at night when it's dark so you can see the lighting of everything if there's adequate lighting around. But when you're walking it, walk it around maybe 5 or 6 at night also. When you start seeing the people coming home from work, you start seeing what they're doing. Are they coming home from work and drinking out by the mailbox? Are they congregating and getting drunk somewhere, doing things they shouldn't be doing? Or are they all like coming home and then going to their apartment and just keeping to themselves? We have properties where all of the above happens. Typically, when you have people congregating and getting drunk, bad things happen. And so I would recommend Um, again, having your property management uh, not allow that. Insurance, open claims, all of that stuff. We talked about that in a few episodes ago. So really, what it comes down to, and I mentioned this before, is like, are you going to proceed with the deal? Are you going to retrade with it, or are you going to walk away? So if you can't make money, if your numbers are saying no, but you go ahead anyway, that's your own fault. I know people who think, well, the number's saying this, but I think we can do this. It's like, well, then why don't you put those into your numbers? And so then they start fudging numbers, and um, then they come to the realization that, hey, maybe this isn't such a good deal after all, and then they end up walking away. So
Well, I mean, some of this has to do with risk tolerance as well. Like you said, they believe they can do it. It's like, well, why bother looking at the numbers if you already believe you can do it? You know, it's
yeah,
like how much risk you want to take and where you want to take that risk.
yeah. And really that's all this is. Underwriting is risk tolerance and mitigating the risk. Due diligence is just figuring out where the risks are, and then your underwriting and your business plan is, all right, we know where the risks are, let's start mitigating them, either by retrading, maybe getting different quotes for different things, or figuring out what's required and what's nice to have. um, so there's a lot of things you can do. Just because you go and do due diligence and you come back with CapEx issues out of 450K more than you were expecting doesn't mean it's a bad deal. Maybe it just means you need to refine it. Now you have more information to carry out a business plan better versus, yeah, your original business plan won't work, but that doesn't mean you can't change your business plan to make it work, whether it's lowering the cost or the price or whatever. So
This reminds me of I think it was a Kenny Rogers song. You gotta know when to hold them, know when to fold them, know when to walk
mm,
away, know when to run.
yeah. So other things, like I said before, sometimes you'll get like loan quotes from a broker. You always need to get your own loan quotes. Even if you went through the broker, a lot of brokers have their own lending. Even if you go through those loan quotes are going to change from what they originally say. So that's going to affect things. If your DSCR, or if your NOI is too low, your DSCR requirements might not get you the proceeds you need to buy it. And so maybe you were planning on buying it at a 70% loan to value, but your DSCR requirement is only going to allow you to get maybe 56%. So then that means you have to come up with that additional equity. And so does that make sense again? And as a general rule of thumb, the more equity you put into a deal, the lower the returns are going to be.
The safer the deal, which means the lower the returns as well.
So where do deals actually go wrong? We sort of alluded to this: the sunk cost fallacy. Time spent. I mean, when you're going and you're traveling across the country to go look at a walk of property, and you spend 20, 30, 50K in due diligence expenses, you don't want to lose that. So um, deal momentum. Is your team aligned? So this is actually funny. Um, on our first deal, Angel and my first deal, we had gone through two different teams before we found it, bought it with a third team. The first team imploded right before the LOI was sent in. The second team imploded a week before we were supposed to close and didn't have any loan products. And then the
Or
third
any money,
team,
right? You didn't
uh,
have accounts, right?
we had some money, not as near as much as we needed. And then the third team made it happen. We got the loan, we got the equity we needed, and we closed 28 days after that. So, is your team aligned? Ego, we're too far in. That sort of goes into the sunk cost fallacy, though. And I talked about the sunk cost fallacy many episodes ago, where and I was talking about driving, and you said that you like to go out for a Sunday drive. But I was
Um,
referring to, like, I was like, all right, you want to go out to Chick-fil-A. So you get in the car, and the nearest one is 2 hours away, and you're on the way to Chick-fil-A, and then 3/4 of the way there, you realize, oh wait, it's Sunday, Chick-fil-A is closed. Do you continue going to Chick-fil-A to verify it's closed and turn around, or do you just turn around and go somewhere else? So
I think that was one of the first episodes you mentioned that.
yeah.
I'm laughing at this one only because I have one partner who I love a lot. He's awesome, but I don't know if it's an ego thing or what, but he keeps, even though it's like, dude, we got to kill this deal, we got to kill this deal. He just keeps trudging forward.
And I know people. I talk to them. I mean, when I was about to lose 175K of earnest money and due diligence money, it's like, hey, I don't know if we can continue doing this. Have you ever lost a big chunk of money like that? And he's like, no, I've never lost money. That is, I think, an ego thing. Because sometimes you have to. Sometimes it's better to walk away. So it says you don't lose money on the deal you walk away from. You lose money on the deal you force to work.
I believe that.
That is true. If you think you lose money on the deal you walk away from, you're going to lose 10 times as much trying to force it to work than that. So if you have any horror stories of due diligence killing a deal, drop them in the comments. Would love to hear what y'all kind of issues y'all have been facing. Frank and I talk about our own experiences, but we're just two people, and there's a lot of experience out there with the listener base and everything. So we'd love to hear comments from y'all. You have anything else, Frank?
I do not.
If you want to learn more about due diligence, you can look me up at ironcladunderwriting.com. I'm on LinkedIn, Instagram, Facebook, YouTube, or whatever platform you're listening to this on, and we'll catch you later. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.